For over a decade, the crypto world has lived by one simple rule. Bitcoin is king. It's the original, the one everyone knows, the asset that turned everyday people into millionaires and grabbed headlines worldwide. Its story is powerful and easy to get. It's digital gold. But what if that's about to change? What if the ground is shifting under our feet? The biggest names on Wall Street are starting to place their bets, and they're not just looking at Bitcoin anymore. They see a massive change on the horizon, one that could put Ethereum on top as the world's most valuable digital asset. This isn't just a hunch. It's a theory built on two huge catalysts that are coming together to create the perfect storm. In the next few minutes, we'll break down how a wave of institutional money and a series of huge network upgrades are paving the way for Ethereum to challenge Bitcoin's dominance in 2026. This is the story most of the market is missing. For years, the argument was straightforward. Bitcoin was the safe store of value, and Ethereum was the risky experimental newcomer. But while everyone was watching Bitcoin's price swings, something was happening behind the scenes. A new financial system was being built, with Ethereum as its foundation. Now, the big institutions have arrived, and they're not just looking for digital gold. They're looking to invest in the infrastructure of tomorrow. Smart money doesn't just want to park its wealth, it wants to make it work. And in the crypto space, one platform stands out as being built for exactly that. The first and most obvious catalyst is the institutional money that's finally starting to pour in. For years, crypto was driven by regular investors, but the game is different now. The approval of spot Bitcoin ETFs was the first step, making it legitimate and opening a regulated bridge for trillions of dollars. But the second step is where things get really interesting. The launch of spot Ethereum ETFs has opened another gateway. While Bitcoin ETFs still manage far more money for now, they mostly do one thing: give you exposure to digital gold. It's a passive buy and hold game. Ethereum is a completely different animal. It offers something much more attractive to a serious financial institution: a way to make capital productive. This is all about Ethereum's native yield. Because of its proof-of-stake system, holding Ethereum isn't passive. By staking your ETH, you help secure the network and earn a yield in return, which is paid out in more ETH. This yield is variable, but for an asset manager or a pension fund, this is a revolutionary concept. They are always hunting for yield, and Ethereum offers a digitally native return on a global asset. Bitcoin, for all its strengths, just sits there. Ethereum works for you. This changes Ethereum from just a speculative bet into something that looks more like a digital bond, an income-producing part of a modern portfolio. But the institutional story is bigger than just ETFs and staking. The other major draw is the boom in tokenizing real-world assets, or RWAs. This means taking real-world things like stocks, bonds, or real estate and creating a digital version of them on a blockchain. Why is this such a big deal? It could make markets that are currently slow and illiquid much faster and more efficient. We're talking about markets worth hundreds of trillions of dollars. While this is still a new and fragmented space, with many institutions testing their own private blockchains like JP Morgan's Onyx, Ethereum is a leading platform for this innovation. Its huge community of developers and battle-tested infrastructure make it a prime spot for projects building the future of finance. We're already seeing major players like JP Morgan and BlackRock using public Ethereum-based technology for some of their tokenization projects. As these systems grow, the need for a global, neutral settlement layer becomes critical, and Ethereum is well positioned to fill that role. Finally, this whole movement is getting a boost from clearer regulations. For years, regulatory uncertainty was the biggest hurdle for big money. That barrier is now slowly being taken down, piece by piece, although significant questions, especially in the US regarding staking, still remain. When you combine the regulated entry point of ETFs, the allure of a native yield, and the massive opportunity of RWA tokenization, you get a powerful engine for institutional demand. Institutional money needs institutional-grade technology. A slow, expensive, or clunky network just won't work. And that brings us to the second, and maybe even more important part of this idea: Ethereum's technological transformation. For years, Ethereum's biggest weakness was its inability to scale. When lots of people used it, the network got jammed and transaction fees, or gas, went through the roof. This was a real problem. But what many people miss is that Ethereum's developers have been working on a long-term plan to fix this. The first big step was the Dencun upgrade in early 2024. It introduced something called proto-dank sharding, EIP 4844, which basically created a new, cheaper lane for data from Layer 2 networks. These Layer 2s are solutions built on top of Ethereum that bundle up thousands of transactions. After Dencun, the cost for these Layer 2s dropped dramatically, making the Ethereum ecosystem much cheaper to use overnight. But that was just the beginning. The next major upgrade, called Pectra, is expected between 2025 and 2026. While the details are still being finalized, it's set to bring a couple of key improvements. First, a proposal known as EIP 7251 aims to raise the maximum amount of ETH a single validator can stake from 32 to 2,048. This would make it much simpler for large institutions to manage their staking operations. Second, Pectra is expected to improve user experience with account abstraction, making crypto wallets work more like modern bank accounts. Beyond Pectra, the roadmap gets even more ambitious. A future planned upgrade, which went live in late 2025 under the codename Fusaka, introduced Pure DAS technology. This upgrade dramatically increases the amount of data Layer 2s can post to the main chain, making them even cheaper and more powerful. This is the key to unlocking true global scale. Vitalik Buterin himself has said this could eventually push transaction fees on Layer 2s down to fractions of a cent. Further down the line, another concept being researched is Enshrined Proposer Builder Separation, EPBS, which could be part of a future upgrade sometimes referred to as Glamsterdam. This is a technical change aimed at further decentralizing the network and making it more fair and stable, qualities that institutions demand. Put it all together, and you see a methodical transformation of Ethereum into a super efficient settlement layer for a global economy. Dencun laid the groundwork. Pectra is refining the experience, and the vision for future upgrades promises hyperscale performance. While Bitcoin's code changes slowly, Ethereum is evolving at high speed. If you're finding this breakdown valuable and want to stay on top of the huge shifts happening in crypto, make sure you hit that subscribe button. We do the deep research to bring you the clear, data-driven insights you need. So we've got a powerful demand story and a revolutionary tech roadmap. But what does the data actually show? When you look past the daily noise, the on-chain data is starting to tell a very interesting story. One of the most watched charts is the ETH-BTC ratio, which shows the relative strength of Ethereum against Bitcoin. When the chart goes up, ETH is outperforming. For the past couple of years, this chart has mostly been down or flat. However, some technical analysts believe the ratio is resting on a critical long-term support level, a zone where major trend reversals have happened before. While Bitcoin has had its time in the spotlight with its ETF launch, Ethereum has been quietly building fundamental strength. But the story isn't just in the price chart. Let's look at the fundamentals. First, the staking rate. The percentage of all Ethereum that is locked up in staking contracts has been climbing, with roughly 30% of the total supply now staked as of late 2025. This reduces the liquid supply available for trading. On one side, you have a potential wave of new demand from institutional ETF buyers. On the other, you have a shrinking available supply on exchanges. Basic economics tells you what can happen when demand rises and supply tightens. Second, look at the activity on Layer 2 networks. Since the Dencun upgrade, transaction volumes on networks like Arbitrum, Optimism, and Base have seen significant growth. This shows that Ethereum's scaling strategy is having an effect. It's successfully moving activity to cheaper, faster layers that still rely on the main chain's security. This growing ecosystem creates a powerful network effect that ultimately drives value back to ETH. Finally, we're seeing sustained inflows into Ethereum-based investment products and a growing number of institutional reports highlighting ETH's unique qualities. The conversation on Wall Street is shifting. A portfolio that includes both digital gold, Bitcoin, and a productive, yield-bearing tech asset, Ethereum, is starting to make a lot of sense. The data suggests this shift is just getting started. Of course, no investment idea is a sure thing, and it's important to look at the risks. First, there's execution risk. Ethereum's roadmap is incredibly ambitious. Delays in major upgrades or a significant bug could shake confidence and slow things down. Second, regulatory risk is still very much present. While things have been getting clearer, a sudden hostile move from regulators in the US or Europe could be a major setback. A crackdown on staking, for instance, could seriously damage the institutional adoption case. Third, there are the big picture economic factors. In a major global recession, investors tend to run for safety. In the crypto world, that has historically been Bitcoin. A major market crash could pull capital out of Ethereum and into Bitcoin, no matter how strong its fundamentals are. Finally, there's the ongoing debate about value accrual. As more activity moves to layer 2s, the question is, how much value will flow back to the main Ethereum chain and the ETH asset itself? While the current design captures value, if L2s become too independent, it could weaken the investment case for ETH. So, where does this leave us heading into 2026? We're at a fascinating point in crypto history. For the first time, two powerful forces are hitting Ethereum at once. The institutional doors are opening, driven by a need for a productive, yield-bearing asset and a platform to build on. And at the exact same time, Ethereum's technology is finally delivering the scale and efficiency that those institutions require. It's a potential feedback loop. More institutional demand drives more development, and better technology attracts more institutional use. Bitcoin has cemented its place as digital gold, and its role as a store of value isn't going anywhere. But the story of 2026 and beyond might not be about which asset is the better store of value, but which one becomes the foundation for a new, tokenized global economy. While Bitcoin built the first road, some believe Ethereum is now building the superhighways. The evidence suggests the race for the top spot is more interesting than it has ever been. What do you think? Is Ethereum on track to challenge Bitcoin, or will the king keep his crown? Let me know your thoughts in the comments below. And don't forget to subscribe and turn on notifications so you don't miss our next breakdown. Thanks for watching.